U.S. President Donald Trump escalating his trade war, talking about retaliatory and reciprocal tariffs on the rest of the world today. He's dubbing it Liberation Day. How should investors prepare? We're joined by Josh Sheluk, portfolio manager at Verecan Capital Management. Thanks very much for coming on the show. But first off, you say tariffs are not a good basis for making investment decisions.
Well, just look at today. We were so uncertain as to what tariffs are going to be put in place, and the market's up a little bit today. So I don't think we've got any more clarity over the course of the day what's actually going to happen tomorrow or at the end of today. And all of this unpredictability, what it tells us is that there's just not a whole lot to decide here. Without any clear path forward, you just kind of have to sit tight and sit on your portfolio allocations as they are.
And even though we'll get some kind of announcements today, we don't know how long the tariffs will be in place. Presumably there's going to be an element of horse trading here.
Yeah, so first of all, you don't know how long they're going to be in place. You don't know what tariffs are going to be put in place. You don't know on which sectors, industries, or companies they're going to be put in place on. And even if you knew all of those things, you don't know exactly what the response is going to be from consumers, from businesses pivoting away from one thing to the next, substituting goods or services. Too much uncertainty to make any sound investment decisions based on.
Let's put up the NASDAQ 100 as a proxy for the big tech stocks. You say that this uncertainty, though, in markets has highlighted the high-flying sectors, the expensive stocks, and their vulnerability.
Yeah, interestingly, I think if we asked everybody, what are tariffs going to do to the market? Which sectors, which companies are they going to hurt the most? Tech would be one of the last things that people would choose.
Yeah.
And here we are today with some of the large high-flying tech companies being the most hit so far this year. So it highlights, one, that uncertainty, but it also highlights how uncertainty is going to impact or can impact the most highly valued or most expensive, if you want to call them that, parts of the market.
Yeah, it is interesting. I mean, these internet giants don't trade in physical goods, which are vulnerable to tariffs.
It's all services, yeah.
Yeah. What about gold? Now, we've had gold hitting record highs. We've had lots of bullish calls. In fact, it seems to be a bit of the notorious one-way trade right now. People coming up with reasons for gold to go higher. You're a bit of a skeptic when it comes to gold, though, longer term.
That's right. A bit more negative on it for sure. And it's tough for me to sit here being negative today with the best quarter in almost 40 years for gold and hitting new all-time highs. But here's the thing. Over the long term, and I'm talking about multiple decades,
right,
gold has a positive return, sure, but nowhere near as good as stocks, and not even as good as most bond portfolios over that period of time. So throw that on, and then add the fact that in the short term, volatility tends to be very high for an asset like this, and it's, for us as fundamental investors, impossibly to value. There's no cash flows, there's no profits, there's no revenues. We can't determine what the right or true or fair value for gold is. So for us, that's a stay away.
I'm just looking here, not sure if we could put up a 20-year chart for GLD. It's a big U.S. equity ETF that holds gold. The 20-year return, and this is just one time period, is about 570%. That's what the units went up because, of course, there's no dividend. Whereas stocks have delivered more, no doubt, almost 610%. That's the S&P 500. But it's not that, didn't beat gold by all that much over that 20-year period.
Yeah, I guess I'm going back even a little bit longer than that. If you go back 50, 70 years to see what I think is a better sample size for how stocks perform versus something like gold. And keep in mind, the measurement period here really matters. Yeah. So if you looked at it from the 80s into the early 2000s, you're not very impressed.
Yeah.
But if you pick the last 20 years, it's looking pretty attractive. Now, gold also had a drawdown for about 30 plus years before.
Post 1988, I think.
You got it, before it hit a new all-time high.
Yeah.
So most investors are not going to have a 30-year time horizon or the patience to sit for 30 years if they do have a 30-year time horizon.
What about, I mean, not to dwell on it, but what about the argument that it's an insurance policy for a portfolio and there's a case for having 5% of your money in gold? Yeah,
there has been a track record of gold being a diversifier to a traditional stock bond portfolio. That has existed historically. Again, some of the issues that I highlighted with it before I think still exist. And you can look at a period like 2022, for example, when you needed insurance. You needed insurance not just against market volatility in both stocks and bonds, but you needed it against inflation as well. And gold didn't hold up during that period as well either, which is the period where you think it would probably be the most likely to perform well out of all of these periods that we experienced. So I just think it's a little bit too inconsistent in terms of a hedge against either inflation or market volatility for us to be very confident in it as an asset class.
Fair enough. Maybe we could have a look at XRE, which is an ETF that tracks real estate on the TSX. You say real estate's been beaten up for about 2 years, and it's catching your eye now. You see some possible opportunities there. Yeah,
we've seen a bit of a rebound there, but going back to the higher inflation, higher interest rate period of time a few years ago, real estate really struggled during that period of time. And here's a sector where the total opposite of gold, really not that loved, a little bit beaten up still, definitely a lot of skepticism around it still, and we're starting to find some more interesting opportunities here. I still think you need to be selective. We wouldn't be running out and buying office or anything like that right now, but certainly in the multifamily residential space, we're starting to get a little bit more interest in there right now.
That's interesting, because people have to have somewhere to live. Yeah, not office. What about retail? Is that catching your eye at all?
Again, another one where we think there's a lot of uncertainty surrounding it. Similar to office, it's too hard. There's a lot of things here I'm talking about that are too hard to kind of forecast in our mind. There's too much unpredictability around it, and we want some degree of certainty. We're never certain about what's going to happen next, about the future. But if our dispersion of expected future outcomes is so wide, it's probably something that's going to be a stay away for us, just because of risk management.
Josh, thanks very much. Josh Sheluk, portfolio manager at Verecan Capital Management.